Hey folks, Dan Frio here, the rate update. Today is January 13th, 2022. When you come back, we're going to go over the PPI numbers, which is a gauge of inflation, and the unemployment claims, how they come in. Don't go away. We're going to talk about that and rates next. Okay, so the headlines today that we're focused in on is the mandates of the Fed. Okay, those two mandates are price stability, which aka inflation, and the jobs numbers. Okay, so today we want to dissect the inflation gauge that the Fed watches or monitors more closely than any is the PPI, and then also the unemployment claims, which just came out. So take it away, Rick Santelli. I'll let him talk about those two things, and when we come back, I'll digest it for you guys to make it easily explained. So watch this, and I'll be right back.
Let's start out, though, with initial jobless claims, 230,000, much higher than the estimate. And we all know that it takes a while sometimes for the post-GPS of holidays, but this most likely is more of an Omicron event. Last month, of course, 207,000, so we jumped 23,000. Revisions, I'm sure, may be forthcoming. But here's the big news. Finally, continuing claims get to pre-pandemic levels. Okay, we were looking at numbers in the low 1.7 million area. Those were March of 2020. We're now 1,559,000. Let's put it this way. We haven't been under 1.7 million since, January? So these are really good numbers on continuing claims. Now let's go to the inflation numbers, shall we? For the December read on Producer Price Index, headline number, half of expectations, up 0.2. The high water mark here was January of last year at 1.2. If we look at ex-food and energy, as expected, up 0.5%. The high water mark here was April of 21 at 1.1. And finally, if we look at ex-food, energy, and trade, it is up 0.4. Call it a tenth light. The high water mark there was 1.0. That was in January of last year. Now, these are the biggies, the year-over-year numbers. If we look at year-over-year headline, it's 9.7%, which is another record. And do keep in mind, we're only going back to 2010 here because they changed the calculation of Producer Price Index. But basically, we have been making records year over year in this series every month since March of last year. Now, if we look at ex-food and energy year over year, 8.3, same thing. We've been doing record after record since April of last year. This is the highest read at 8.3. And finally, ex-food, energy, and trade year over year, 6.9%, as expected, equaling our last look at 6.9. All this is still unrevised, and that equals the highest ever at 6.9. So just like Consumer Price Index, the Producer Price Index year-over-year numbers are hot, hot, hot. But they're exactly as expected, except for the core number, which was 8.3 versus the expectations of 8. And the 7.7 last look was also the all-time high. How's the market digesting this? We're still a whisker under 1.74% in 10-year note yields. On a closing basis, of course, we're a couple basis points under the highest close of the year, and indeed the highest close of a couple of years. And many scratch their heads. But once again, inflation and how the market processes it and how the Fed deals with it is an ongoing process in the midst of QE with almost a $9 trillion balance sheet. So if you think you know where that red dot is, you are here. You're smarter than most.
Okay, there was a lot there to unpack, but what I want you to focus in on is the PPI number that came out for the month. We're not going to focus in on the year to year. Okay, the year to year is nuts. But the monthly change was up 0.2. Okay, that's cooled off. Okay, the expectations was for 0.4, but it came in at 0.2, half of what was expected. That's good news. The other piece is the continued jobless claims just dropped to pre-pandemic lows. Those are two of the things I'm going to focus in on. Yes, we can always find some news to say, okay, the world's ending and whatever. But those are two great components that came in with favorable numbers. Now, this isn't, think of this as a barge. Okay, I grew up in West Virginia on the Ohio River, and the barges would go down the river. It was really difficult for them to turn. So think of the economy as the barge. It's going down there. Just because it's like, oh, unemployment benefits stopped, well, that means everybody's going to go back to work. No, it's going to take time for that barge to gradually move and turn. The same thing with a lot of these things. We as an economy, we as a people, we expect everything just to be instantaneous, but it's not when it comes to this stuff. Okay, just let's be clear on that a little bit. So the next thing I want to say is, how is this affecting the MBS market? Well, what in the world is the MBS market first? Well, I get in debates with people every day on this one. So let me go over and explain to you what the MBS market, or why I focus in on the MBS market. So let me get me out of the way, and we'll go over to this. And this is what I'm going to start posting every day as well. I got new formats coming on a daily basis. So I hope you're excited when it comes about a month from now. You're like, Dan, what you're doing is really helping us. Okay. So the biggest thing I want to focus in on is right here. Zoom. Interest rates are typically determined by the bond market. Okay. All right. However, mortgage rates, for instance, are directly tied to mortgage-specific bonds known as mortgage-backed securities. Okay? I can't be any clearer. MBSs tend to move a lot like the U.S. Treasuries, despite trends of slight So it moves in the same, usually trend line is Treasuries, but when you want to look at the direction of mortgage rates, you follow the thing that's directly tied to it, which is mortgage-backed securities. So I'm going to put that part to rest. So now, what's going on today with the mortgage-backed securities market? Well, let's refresh it. We're at 0. I will take that all day long, because you saw there was days down 50, down 30, down this. So this, again, when this is down, that means rates are going up. Okay, please remember that. This is not rates. Okay, this is the price of the bond, mortgage-backed securities. As it goes down, rates go up. Okay, as it goes up, rates go down. So we want to see this number either black, green, and not red. Okay, so that's the direction. So the market absorbed the data today, and they're like the 9% inflation number, and they're like, okay. So they're looking in more detail to a lot of this stuff, like me and you are doing right here, than the average market out there or the mainstream media. All right. So that's the news right now, and that's what's going on in the MBSs. Where are mortgage rates right now? Well, this is the mortgage rates that is compiled by Mortgage News Daily. Okay. They do this. They survey mortgage lenders all over the country, and it comes back, and here's the average rates that they come up with. The 30-year fixed rate is 3.52, or down 7 basis points. 15-year is 282, down 3 basis points. The 30-year FHA/VA, 319, down 3 basis points. 30-year jumbo, 322, down 5 basis points. And the volatile 5/1 ARM is down 6 basis points. Still not sure why somebody would do an ARM in this environment right here, when you can still get a lower rate when it comes to the fixed rate markets. Okay, so that's what we've looked at right now. So we went over, what the headlines are saying, how they're being absorbed by the markets, and how that's affecting mortgage rates. So now let's go to the economic calendar. Is there anything else in store for us? So today we saw the initial jobless claims. The initial jobless claims were up, and people still, is it the Omicron or so forth? So not quite sure, and I don't think really anybody knows that piece. But the continued jobless claims have been dropping. Okay, so that's great news. The PPI, as you can see, it came in at 0.2. The expectations was 0.4. The last reading we got was up 1%. It's cooling. Okay, the last economic calendar we had on this was up 1% for the month. Expectations was 0.4. We came in at 0.2. Great news. Retail sales and everything's coming down here. I'm not even going to pay attention to that, because I don't think that's going to affect the markets. So that's my report for right now and what's going on with mortgage rates. So if you're in the process right now, first off, please, if you find value in the channel, give me a thumbs up, subscribe down below. The more subscribers we get, the better our analytics and the more people we can reach. And only you guys can help me there. All right. So if you're in the process and you're looking for a mortgage for any reason at all, let's say you're building a house, buying a house, refinancing, cashing out, doing a reverse mortgage, all these things. We have debt servicing for investors out there that are looking to buy houses, refinance investment homes, and so forth. We have programs like that. We have bank statement programs. If it's out there, we have it. We joined the largest brokerage in the entire country. So it opened up a whirlwind of products for us. And that's why we did it for you guys. It also allows us to shop over 130 lenders to find the best rates and the best pricing and the best programs around in the market for you guys. So we should be your one-stop shop. Okay. So how to reach out to us, give us a call, 844-775-5626. Or schedule a meeting. You might be on the West Coast. I'm in Chicago. By the time you get home, have dinner and everything, I'm probably in bed. So you can't get me. Well, schedule a meeting. Okay. The next thing is if you're like, Dan, I need your help. I know you can help me. I trust you. How do I just get the ball rolling? Well, hit the apply now button and you're on your way. Thank you so much for watching. When I come back later today, I'm going to give some context of what I missed yesterday. I was out sick. I haven't really taken a sick day in years and years and years, but I couldn't bear the headache that I had. So thanks for your patience. I'm back. I'm at it. God bless. Have a great day, and I'll see you later this afternoon. Bye-bye.